Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Carl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast.
Welcome, everybody, to the Expert Network Team podcast. I'm Carl Frank here at A&I Financial Services, and with me today I've got Nate Merrill from Goodspeed and Merrill. How are you, Nate?
I'm doing excellent.
Looking good, my friend. And in the room also is our guest of the day, Jeff Cromendike. Jeff, you are both an Expert Network Team member since inception and a expert about insurance, which is our subject today. How are you?
Great, thanks.
So
happy to be here and talking about insurance.
Which is something you love.
I do. I'm excited about it. I'm a little bit of a insurance geek in that.
I wish we could
that
talk
respect.
about tax.
Oh my, we always talk about tax.
I'm sure you'll find a way to work it in somehow, Nate. You always do. Well, I am actually happy that you're happy about it, because the news that you gave to us before we began just seems really bad to me. It seems like insurance rates, the outlook in 2023 look like they're going up. And so as a payer of these insurance rates, I'm really interested in what I should be looking for, why this is happening, and we're going to put it in perspective too. So I'm really excited about it.
Yeah, on that note, perhaps you can just first give us, because everybody follows the markets for investments. Everybody kind of has a finger on the pulse of how much their car, their milk, their cheese, their eggs are costing, but we don't pay as much attention to our insurance rates over the years. So maybe you can explain kind of how insurance rates have behaved historically, maybe last 20 years or so.
Yeah, it's a great question. I think, like a lot of the markets that we talk about, whether it's the financial markets or economy, things like that, the insurance industry and the insurance markets also cycle. They trend up and down, and we really talk more in the insurance industry specifically about hard markets and soft markets. So we'll probably use some of that terminology here today, and just know for our listeners here this afternoon that when we talk about a hard market, it's hard in a couple of ways. First of all, premiums are going up. Insurance premiums are on the rise when we talk about a hard market. And then we also talk about underwriting guidelines get tighter or more difficult for insurance companies to accept risk. And so they underwrite risk and scrutinize it at a much greater level in a hard market. And so overall, it's a hard market because higher premiums are hard to pay and getting risk underwritten is hard. So we are, I would just say, without, probably spoiling anything here this afternoon, everybody is probably experiencing what I'm going to just go ahead and go public with is that I think we are officially in a hard market from an insurance perspective. We will also reference soft markets, which we're coming out of. We've had a pretty good run here since 2012, 2013. Been in a pretty flat, soft insurance market. Premiums have stayed relatively either flat or have even gone down a little bit. But starting in 2016, 2017, we've been inching up. And now most recently, I would just say, Q2 of 2022, Q3 of 2022, we're up close to 10 to 12% as an industry. But let me just take us back to like the late 90s even, and maybe just talk specifically about where the insurance industry was at in 2001. We had quite a few things going on. You guys can bring some commentary to this, but certainly we had 9/11, which I think really woke us up as a country in a lot of ways. But I think simultaneously, what may have really brought the financial markets down was the .com crash that occurred right after that, or really in conjunction. And maybe 9/11 had something to do with that, but nonetheless, we had a pretty good drop in our economy and also in the markets. And it was during that period of really 2000 to 2003 that the insurance industry experienced a much larger hard market than what we're even seeing or maybe even approaching today. It was upwards of almost 28.5%, ranging basically from 2000 to 2003. And then we went into a pretty soft insurance market quickly after that. The economy recovered briefly till about 2008, 2009 rolled around. And the insurance industry is always a couple of years probably behind. Yeah, right. Lagging a little bit from the mortgage crisis that we incurred. We really didn't see the insurance industry get hit by that till about 2010. And then we spiked up a little bit and then again fell down into a relatively flat and softening market here until 2017, 2018, where we started to see some increases. So that's just a little bit of a history lesson.
Yeah.
And
two takeaways I take from that are, just looking at these graphs, and I don't know if it's something we can link up or not, but the one positive takeaway, because Carl, I know you're always looking for the bright side to these things, and is that it could be worse, because the percentage of rate increases that we apparently saw in the 2000s, which is before I was really paying attention to insurance, appear to be more dramatic than the ones we're presently facing. And I know we're going to get into that. I mean, the graph just looks more extreme. I don't know how much of the story that graph tells, but the flip side of that is that as the market recovers, these aren't permanent rates. This isn't right. Like inflation where it stays at an inflated rate. They can actually reverse and come down, correct? Am I reading that correctly?
Yeah, they can certainly. And we'll probably talk a little bit about a few of the factors that, can certainly thrust us into a hard market. And those factors that can kind of bring us back down into a softening insurance market too. But I think that is true. I mean, everything is having some impact here with regards to inflation, and I would say insurance is no different, but maybe for a different reason, not because necessarily it's just going up because everything else is going up, but we're insuring property, and when property inflation occurs, you're just going to see your rates go up because you're insuring more property today than you were a year ago.
Well, let's do there's another podcast that we can probably link up to this where we talked about the fires that happened in
the Marshall Fire.
Fire, where we were talking about how folks found themselves underinsured because property values had risen, cost of replacement had gone up. There were all sorts of factors where if you're not monitoring your property value versus your insured amounts, you can find yourself in a pinch. But what I'm reading into some of the tea leaves you're laying out is as property values go up and the costs involved in building or replacing or reconstructing go up, so are insurance rates.
Yeah, you're just insuring more property now.
Well, it could be the same house. It's just worth more.
It's worth more, so we need to insure it for more, and therefore your rates, go up. So there's certainly some of that.
And that's going to happen external of the factors that are impacting insurance, because it's just a reflection of what's happening to your home value or now there are some things I'm sure you'll talk about where risks are increasing, like the cyber areas where there just seems to be more exposure.
Yeah, absolutely. And I think that might be of anything, if there's anything we can point to that's a culprit for, bringing us now into a harder market has been the catastrophe and the catastrophes that we've had in the last several years. And, again, insurance is highly, dependent on geography, especially when we're insuring property. Liability, not so much, but I would say we can point pretty quickly towards a really struggling property market right now, primarily due to the incredible amount of catastrophe type events that we've had. And
like the hurricane in Florida.
Yeah, that would
Marshall
be
fires here.
that would be
The Marshall
one.
fire in
Certainly the
Colorado.
fires. There's been a lot of storms that we really maybe just depending on where you're located don't even read about or hear about in the news. But there's just been some incredible wind events in the Midwest, and we're not talking like tornadoes, named tornadoes. A lot of them are straight line winds, and it impacts the insurance industry immensely. And there's just an incredible amount of damage when events like that occur. But we've
sorry to interrupt.
Yeah.
For the locals, there was the Marshall fire, which is obvious, and that's kind of a random 100-year event because just the way
it was so big.
But you were saying, maybe you can speak to this. Some of the mountain properties are seeing dramatic increases in premiums. That's obviously a local condition that's impacting the cost of insurance. But is that somewhat being impacted by some of the fires that we saw in Glenwood Canyon and stuff like that? Those didn't actually hit residential areas as much, but showed the vulnerability of the mountain conditions.
Right. Yeah, the Marshall fire really changed things forever for us. When we had a podcast on this probably 6 months ago or so. But, first of all, everybody was watching it unfold on national TV, right? So
1,000 homes or something?
1,000 homes in, less than 24 hours. And so it was a pretty amazing event that was just unfolding in front of our eyes. And it's not that the insurance companies needed to see it on national TV. They were living it in real time, but it was really an unprecedented event. And I would, we talk about 100-year events here in the insurance industry, 100-year floods, things like that. This was just unfathomable. We really literally had a blowtorch, at anywhere between 80
in the middle
and
of December or the end of December.
100-mile-an-hour winds, and you put a match to it, and it literally took trees and thrust them hundreds of yards into neighborhoods and so on and so forth. So it was a end of times type of event, and it's really now changed the way insurance companies are looking at brush exposure. I really don't know that we ever imagined that we could have experienced something like we experienced. That was a neighborhood. We all live in neighborhoods like.
I was on the verge of the evacuation zone.
Really?
It was within a mile or two of hitting us.
So, well, that was a big event. Again, from an economic perspective, it was still limited to about 1,200 to 1,500 homes. So it wasn't, in comparison to some of the large hurricanes and even hail events that we've had here in Colorado, but it did kind of let all the underwriters and actuaries know what Mother Nature was capable of. And so now we've got an immense amount of, brush exposure here in Colorado, as well as all the other, states, in the western part of the United States here. And we're just underwriting things much, much differently. And so that's contributing to it. But just to kind of give you guys a little bit of an idea how catastrophe type losses do impact a hardening or a soft market. But, I don't know if I've been living under a rock here for the last, 6 years or so, but there's been annual insured losses of more than $100 billion globally for the last 6 consecutive years.
Really?
And last year, it was a staggering $140 million.
Wow.
I'm sorry, billion with a B.
Is it worldwide or
$billion.
United States?
It is globally.
Okay.
Which we are in a global market in the insurance industry,
What does
obviously.
that compare to? Do we know how big it was before that? That sounds huge.
Yeah, well, I don't have any, real historical data. Obviously, you've got to put inflation in those losses. For example, our largest loss here in Colorado was actually in 1993. It was a hailstorm. It was basically valued at 660 million in 1993. This hailstorm that we had, I think this was in 2017, Father's Day weekend, or no, actually May 8. It damaged, started in Golden, Colorado, and damaged
the mall
the
out
mall
there,
out there.
Colorado Mills, yeah.
Yeah, and
remember that.
that ended up being a $2.4 billion loss. Now,
Inflation adjusted.
you take inflation on that
Yeah.
93 storm, move it to 2017, and that was about 960 million. Okay,
Wow.
comparatively. So that tells you just how much larger that storm was than our first number one documented storm
Right.
in 1993. And that storm, by the way, started in Golden, Colorado, and exited the country in northeast Wisconsin.
That's a big storm.
And so now we're taking this storm, and it's not just the
Magnifying the
damages that had
geography.
occurred here in Colorado, but from an insurance industry perspective, it was a massive storm,
So-
a top 10 storm in the nation, actually.
This may be something you can or can't answer based on the data you have, but I'm curious if the insurance markets and how you cover these losses has changed in that period of time, meaning are coverages expanding and therefore more exposure arises when a catastrophe hits like that? Were they tighter? Were they, I think of the movie The Jerk, if you remember, with Steve Martin when he was at the prize, giving away prizes, and he's like, well, you can have anything above this line, to the left of this line, under this line, over here, and it was like one prize. Has the insurance market expanded through competition to actually cover more things, thus resulting in more loss, or is it actually going the other way where it's covering less and we're still having these massive losses?
That's a good question. I think since the hail really started flying again here, which was kind of in 2010, we started getting very consistent hailstorms here in Colorado. And by the way, we're I think number 2 in the nation right now, only behind Texas.
Is that a good thing?
Oklahoma and Colorado kind of swap positions there, but I would say now as a result, coverage forms are getting less broad. We're asking the insureds now to take some of that risk with us as insurance companies.
Higher deductibles.
So got higher deductibles. We're seeing a lot of actual cash value roof coverages now, which we never saw before. Just depends on the age of the roof, especially for commercial buildings. So I would say that the coverage forms are getting a little bit narrower. But I think what the difference between the 93 storm, because these storms were really in pretty much the same area, and the 2017 storm was just density.
Yeah.
I mean, there's just Denver built out.
I hear that a lot about the hurricanes too. It's
Yeah.
not that the hurricanes are happening with more necessarily intensity or ferocity. It's just that
Right.
we have built out the entire region, so we're going to get hit.
Yeah.
They might have got you. They may have missed you or glanced you 10 years ago. Now it's going to be a direct hit wherever it goes.
Yeah. So I would just, to kind of put the bookends on that. I mean, catastrophe losses, and when we're in a season or a time where we're seeing more frequency and severity, that's going to thrust the insurance industry into a hard market. The other thing is, we talked a little bit, is just the mixed investment returns that they're able to get. And Carl, you know this better than anyone does with regards to how insurance companies invest their money. But when they're not making money underwriting risk, they're usually making money investing.
That's right.
Their premiums. And so we are not making money underwriting risk right now, and we're not making money investing right now. So that's going to,
like a perfect storm.
really go ahead and make a capital call to the insureds with regards to increased premiums.
Now you got to pay more.
Right. We talked a little bit about inflation. That is a big deal. We're insuring more property now because it's more expensive to replace. And then there's this other thing in the insurance industry, which a lot of consumers don't understand, which is really the reinsurance market. The insurance companies that you're doing business with right now have a name. We won't list any in particular, but your insurance company really is name only in a lot of respects, and they may be insuring maybe the first $1 million of your exposure.
Mhm.
And then they actually sell the next million or 2 or 3 layers to other insurance companies that you don't even know the name of.
Sounds like AIG.
Yes. Yeah, there you go. We weren't going to name any names.
Oh, I was just thinking of how they were the ones that got us into that whole mess.
The financial crisis. Yes. They became famous for bad reasons.
Yeah.
Right. So the
Years ago.
reinsurance market right now is super tight. There's a major supply and demand problem there where there's just not a lot of capacity in the reinsurance markets. And now what we're seeing, when you do get reinsurance, you have to pay a lot more for it. And that's
They got
now
more expensive.
trickling down to the
Is there a
insurer.
reason why reinsurance just has less capacity? There's not as many companies providing it, or is there anything you know about that caused that to happen?
Yeah, I think we'll see less capacity in the reinsurance market typically when there's just a lack of underwriting profit, and specifically when there's catastrophe type cycles
Right,
that we're in.
So they want to be there when it's easy to make money, and they're going to tighten up when it's harder to make money.
Yeah, there's a lot of different treaty stuff that goes on behind the scenes that I'm not super familiar with, but nonetheless, the reinsurance market right now is really driving a lot of the hard market.
You made a really good, interesting comment to me, at least, about the investment performance, because we've come out of a decade of near zero rates of return. So insurance companies love to invest in fixed income investments where they've got a guaranteed return of some sort, or at least some sort of a steady return, and then they can forecast much better how they're going to spend their money and make their money. But when the rates are lower, then they have to make their money somewhere else with underwriting. And now we're at a time of after last year's interest rate increases and 2023's interest rate increases, where they can actually start to make money on their fixed income investments. So maybe in the future that'll help lessen the hardening market, or maybe even soften the market. Am I too optimistic there?
You may know more about that than I, Carl. Actually, I think insurance companies are typically pretty conservative with regards to their investments, and so a lot of the fixed return type products are typically something that they'll invest in. So yeah, hopefully, I mean that's good. We don't see these cycles lasting, especially harder markets, lasting very long. Usually, less than 2 to 3 years. And I mean, historically, that's been the case. We'll typically stay in a soft market, which is great for the insurance consumer. Usually you're seeing lower rates and companies competing for your business, but those will stay, those will trend to be a little bit longer, 4, 5, 6 years sometimes. So,
well, that's good news.
Yeah. So I don't think we're going to be here a lot longer, but probably a year or
a few
so.
more years. That's another question. Does it matter what type of an insurance company? So some of these insurance companies are stock companies, some of them are mutual companies. Does it matter what type of an insurance company is in there, or is everybody all across the board deciding at the same time? And that sounds a little bit like collusion, but but maybe not.
I think
Spoiler alert.
Yeah, they do. They do keep an eye on each other, obviously, right? They want to maintain market share or gain market share. Some of them are, quicker to the party than others. And as an insurance agency or a brokerage, we try to play that game a little bit, make sure that our clients are with the companies that are lagging and maybe haven't come to the rate game yet. But it usually 6 to 12 months, they've all woken up and they've all decided that, clearly the market is justifying these types of increases, and therefore we probably better get on board or we're going to lose our rear end. So we'll start to see some companies, some leaders, some some on the forefront of a trend and begin to try to gain some market share. So it's really a great opportunity and we'll see the direct writers do this a lot. Companies like Farmers, Allstate, American Family, State Farm, they'll see an opportunity in a hard market, and they'll just go ahead and start buying business. And when that starts happening, we know there's going to be a shift probably in the market.
And when you say buying business, they just offer
Lower rates.
significantly under market rates. I was going to ask on that because I know with the bank sometimes you'll go from bank to bank, and your opportunities will vary based on what they're trying to put on their balance sheet, whether it be long-term loans,
Mhm.
short-term loans, revolving credit, that sort of stuff. Do you see the similar type of attitudes in insurance where some, like you were just, I think I just answered my question, or you answered it in advance, is there are some insurance companies that may be heavy in auto and life or something like that, and they want to pick up some business and the general liability and cyber, so they might actually go after that market, or how does the market behave competitively like that?
Yeah, I think there are some fluctuations product to product, right? Where they're, really losing the rear ends on, commercial auto right now, right? For example, is just really, really hard. The industry just hasn't made money in commercial auto for many, many years for many different reasons other than
When you
just a
say
hardening
commercial auto,
cycle.
that's like our
Fleets,
fleet. So
yeah,
like truly
fleets,
commercial auto,
yeah,
not like individual auto.
right,
Got it.
yeah, commercial, yeah, business owned autos, things like that. And so those companies will pivot, they'll move away from that and start, trying to gain some market share in maybe, I wouldn't say property. Nobody wants property right now, but, it could be general liability or workers' comp is an extremely profitable piece of business right now in our sector. There's signs that it's starting to become less profitable, but it's really everybody wants workers' comp right now. So yeah, there is some of that shifting around for sure.
Jeff, what can us consumers and insurance premium payers, what can we do in a hardening market like this? I mean, do we just pay it, plan for it, budget for it, or is there anything else we can do to,
There are mitigating factors that we can.
Yeah, I mean, there's a
Yes.
few things that we can, certainly, suggest, and I think it's important that we as consumers do keep an eye open, and I think insurance is one of those things that we become pretty complacent about, especially as personal consumers, like home and auto insurance, right? Usually our, commercial uh, clients are typically, reviewing their insurance on an annual basis and bringing it out to market. But, I would just say, get out there and see what's available. If you've been with your same carrier for last 5 years, 10 years, I mean, I know people who've been with same company for 25 or 30 years, so it might be time just to, come up for some air and take a sounding and figure out what the market's doing. You might be surprised. The other thing I would just suggest, even from I'd say more from a commercial consumer perspective, really begin to take an investment in managing your risk, other than just trying to transfer it in a less expensive way. Insurance is a transfer of risk, right? And we're always managing those premiums. But what can we do as business owners to actually eliminate the probability of even having a claim going forward? Because we do know that fewer claims lead to lower insurance premiums. And the reality is having a claim is not great for anybody. It's not a good experience, first of all. We can have business income loss. We have to pay a big deductible. There's just a lot of expenses when it comes to having a claim. So we're really focused on trying to educate our commercial clients around loss control and safety, risk mitigation, as opposed to just risk transfer. And so that's one of the things that I would suggest. And then just continue to just continue to create a culture of safety. Work related injuries or continue to be a thing that are very, very costly to a company. And then manage claims when they do happen too. And these are things that agents, a good brokerage should be doing, is they should be managing the claim alongside you, making sure that it doesn't get out of hand, making sure that it doesn't get too old or stale. That's when things get expensive. And so there are some very proactive things that we can be doing. We can start thinking about higher deductibles. We can there's some things as consumers we can do proactively, but for the most part, it's like hold on tight for a while. And I would just say there's a couple of areas to be concerned about. One is property, so that includes all of us, right? We insure homes, we insure business property, we insure buildings, like the one that we're sitting in right now. You can just count on 20 to 30% rate this year here in Colorado in particular. And then cyber liability is another one. All the resources that we've been, reading about here in the last couple of weeks preparing for this podcast would be cyber's likely to go up 100%. And we can talk about why that is, maybe on part 2 or another podcast. But those are the two, I would say, hot areas right now. The reinsurance markets are filled to capacity in both of those areas. And then liability is taking some temperature as well. It's a little bit more difficult to get some of the higher excess liability limits that we're looking for, 5 million, 10 million, 20 million. There's just not a lot of markets available for those kind of limits. So that's just kind of an overview as to what you can probably expect when you get your next insurance bill. You can expect some property rate and
expect some sticker shock.
Yeah,
it sounds
definitely.
like. Jeff, thank you so much. This is a great, informative podcast. It's best to know ahead and be able to plan for insurance rates like that. That's great practical advice for all of us, and it puts it in perspective. And maybe there's a little optimism that it won't last forever. Maybe rates will go up for a few years here.
Gotta give you something to look forward to, Carl.
Got to look forward to something.
Yep.
Well, if there's no further thoughts,
I think I'm good.
I just have to say that, Jeff, you made insurance as interesting as I make tax. So let's
just doesn't
ponder that one for a bit. But
Yeah.
otherwise, no, I'm good.
all right, everybody, create a beautiful day.
Thank you.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else and join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.